The Paycheck Protection Program, or PPP for short, was a business loan program authorized by Congress as part of the CARES Act to help small businesses continue paying their workers during the period of disruption from coronavirus. In total, the program authorized almost $670 billion in forgivable loans to small businesses. But what does this mean and how did it actually work? Where did the money really come from? I'm a vice president at Altamont Capital Partners, a private equity fund based in the Bay Area, and I'm on a mission to demystify the world of finance with storytelling. So as a small business owner, what does this mean for you? Well, you were working directly with your banking relationship. It was no different than applying for a normal loan. You would go to your bank, whether it was a regional bank or a national bank, and apply for the PPP loan. Now, the money would come to you from that bank. You didn't know about all the complexity that was going on the back end, who was guaranteeing the loan, who was providing the liquidity to your bank for the loan. All you knew is that you were working directly with your bank and getting that loan directly from them. The program was run through the SBA, or Small Business Administration, a government agency with a mandate to provide support to entrepreneurs and small businesses. But banks were the ones actually tasked with making the loans. The idea there was that banks are in the business of making loans, so are good at the administrative processes that come with that. The government program essentially called on the banks to do this part because they are good at it. The key here, though, is that the banks wouldn't be asked to take the risk from the loans. They were forgivable after all, so that wouldn't have been fair to ask the banks to do. So the banks were making loans. The loans were backed by the SBA, which is supported by the Treasury, or the full force of the US government. But the government had to make sure the banks actually had money or liquidity to lend, particularly when things were really bad back in March and April. So the Federal Reserve established the Paycheck Protection Program Liquidity Facility. This essentially had the regional Federal Reserve banks making non-recourse loans directly to the banks that were originating the PPP loans, using those PPP loans as collateral. So this is simplifying, but think of it like this. The regional Federal Reserve banks provide liquidity to the commercial banks. The commercial banks then originated and processed the loans to small businesses. The SBA and Treasury provided a guarantee on all those loan funds to these banks. It sounds complicated, and it's because it is, but these are the basics of how it worked. So the aspect of forgiveness here is interesting. This was the same as all of the other spending that the government was doing during this period, alongside the stimulus checks. Treasury needed to come up with the money to pay for all these programs. And so it goes back to the whole idea of deficit spending, of raising the money via borrowing. The Treasury was issuing new bonds, bills, and notes, and finding investors to buy those and provide them with the funds they would need for the stimulus checks, for the forgiveness on these PPP loans, etc.
Invest in you. Ready, set, grow. CNBC and Acorns.